February 6th, 2026, 2:14 p.m. Eastern. Someone had just filed paperwork that could collapse the entire commodity system. 25 million ounces of silver, not paper, not promises, physical metal. And the vault doesn't have it. This isn't a market correction. This is a bank run. And most people are staring at their phones, watching a number on a screen, while the real war just ended in the warehouse. By Monday morning, someone has to deliver metal that may not exist. Welcome back, folks. This is your OG, John A.G., and if you've been following markets long enough to remember when handshakes meant something, when contracts were honored, when your word was your bond, then do me a favor. Hit that subscribe button like you'd sign your name on a business deal you believe in. No algorithms, no games, just real analysis for real people. And drop a comment below. Tell me where you're watching from. New York, London, Singapore. Let's see who's paying attention while the system cracks. Now, let's talk about what just happened and why your portfolio might be built on a lie. Friday afternoon, February 6th, 2026, 2:14 p.m. Eastern Standard Time. Most traders were wrapping up their week. Coffee cups sat half empty on desks. Screens displayed the usual end-of-day price movements. Silver was trading at $76.20 per ounce. Nothing unusual, nothing alarming. But in the digital filing system of the Chicago Mercantile Exchange, something extraordinary had just occurred. A delivery notice landed in the COMEX system. Not the typical kind, not the standard 50 or 100 contracts that might filter through on any given month. This was different. 5,000 contracts. The number sat there in the database. Cold, factual, undeniable. Each silver futures contract represents 5,000 ounces of physical metal. The mathematics were simple. 5,000 contracts multiplied by 5,000 ounces equals 25 million ounces of silver. 25 million ounces. Not a request for cash settlement, not a rollover into next month's contract, not a negotiation or partial delivery arrangement, a demand for physical metal. The entity behind this notice remained anonymous. The filing showed only a clearing member code, no name, no country of origin, no public statement, just a legal document requiring the COMEX to deliver 25 million ounces of actual silver bars to designated warehouse locations by Monday morning. To understand the scale of this demand, one must understand the normal rhythm of commodity markets. In a typical month, the COMEX processes between 50 and 200 silver contracts for physical delivery. Most months sit closer to the lower end. These are usually industrial users, manufacturers who need silver for electronics, solar panels, medical equipment. They file their notices weeks in advance. The system processes them smoothly. Metal moves from registered vaults to delivery accounts. Paperwork gets signed. Trucks get loaded. The system was built for this flow. But 5,000 contracts in a single filing? This represented more physical demand than the COMEX typically sees in 6 months, compressed into one transaction, with a 72-hour delivery window. At current prices, this single demand represented approximately $1.9 billion in nominal value. Yet, when the notice hit the system at 2:14 p.m., the silver spot price barely moved. No spike, no panic, no algorithmic response. By 3:47 p.m. Eastern, silver closed at $76.20, exactly where it had been trading mid-afternoon. The Financial News Network said nothing. Bloomberg's commodity desk published no alerts. CNBC's closing bell coverage made no mention of unusual activity in precious metals. The silence was telling, because when markets function properly, when supply meets demand in transparent fashion, a $1.9 billion physical delivery request does not go unnoticed. It creates immediate price pressure. Traders react, algorithms adjust, the information spreads. But this market did not react, because this market operates on a different principle. The commodity futures system was designed around a simple assumption, an assumption that has held true for decades, an assumption that makes the entire pricing mechanism possible. That assumption is this: 99.7% of all futures contracts will settle in cash. Traders buy contracts, prices move up or down. At expiration, the exchange calculates the difference between the strike price and the settlement price, transfers money between accounts, and closes the contracts. No metal changes hands, no trucks get loaded, no warehouse receipts get issued. The system depends on this behavior. The leverage ratios are built around this behavior. The inventory requirements reflect this behavior. And for years, it worked perfectly, until someone decided to break the pattern. This unknown entity looked at their 5,000 contracts and made a choice. They did not want dollars. They did not want a wire transfer showing paper profits. They did not want to roll their position into March delivery. They wanted the metal, all of it, now. And in making that choice, they forced the COMEX to do something it rarely has to do: prove that the metal actually exists. The filing sits in the system. The clock is running. Monday morning approaches, and somewhere in New York, in the offices of the exchange, in the compliance departments of major bullion banks, People are asking a very simple question. Can we actually deliver 25 million ounces? The answer to that question is more complicated than anyone wants to admit. Imagine walking into your bank on Monday morning. You have $100,000 in your checking account. The statement says so. The app confirms it. You have never had a problem accessing your money. Now imagine asking the teller for all of it, in cash, in $100 bills, right now. The teller's smile would freeze, because your bank does not have your money sitting in a vault with your name on it. Your bank has loaned that money to 30 other people. Your $100,000 exists as a number in a database, backed by a fraction of actual currency and a mountain of promises. This is called fractional reserve banking, and most people understand this system, at least in theory. What most people do not understand is that the same principle applies to the metals market. The COMEX operates on a similar structure. When someone buys a silver futures contract, they are not buying silver, they are buying a promise, a legal agreement that says, at a future date, they have the right to receive 5,000 ounces of physical metal, or the cash equivalent. That last part is critical, or the cash equivalent. The system was designed with an escape hatch, a relief valve, a way out. Because the people who built this market understood something fundamental about human behavior. Most traders do not actually want the metal. They want exposure to price movements. They want to profit from volatility. They want liquidity. Physical delivery is messy. It involves warehouse fees, insurance costs, transportation logistics, assay verification, storage arrangements. So the COMEX created a system where physical delivery is technically possible, but economically discouraged. And it worked beautifully for decades. Here's how the machinery operates. At any given time, the COMEX maintains two categories of silver inventory: eligible and registered. Eligible inventory means silver that meets exchange standards, the right purity, the right bar size, stored in approved warehouses. But this silver is not available for delivery. It belongs to someone. It is sitting there, waiting, but it is spoken for. Registered inventory is different. Registered means the metal has been officially earmarked for potential delivery against futures contracts. It is the pool that the exchange can draw from when someone files a delivery notice. As of February 5th, 2026, the COMEX reported 41 million ounces in registered inventory. Sounds like plenty when faced with a 25 million ounce delivery demand. Except, registered does not mean available. Some of that metal is already committed to other contracts that have not expired yet. Some is being held as collateral in the overnight lending market. Some exists in warehouses that are geographically separated, making rapid consolidation difficult. And some is counted multiple times. This is where the system gets interesting. The practice is called rehypothecation. It works like this. A bullion bank holds 1 million ounces of physical silver. They use that silver as collateral to borrow money from another institution. That institution then uses the same silver as collateral for a different loan. A third party accepts it as backing for a derivative position. The same 1 million ounces now appears on 3 different balance sheets. 3 entities believe they have claim to that metal. All 3 are legally correct, under normal circumstances. But normal circumstances depend on one critical assumption, that all 3 parties will never ask for the metal at the same time. This is the leverage model. The paper market for silver is enormous. Estimates suggest that for every ounce of physical silver in existence, there are between 100 and 250 ounces of paper claims. Some of those claims are futures contracts, some are options, some are exchange-traded funds, some are bank certificates, some are allocated accounts that are not actually allocated. The system creates artificial supply through financial engineering, and it works, as long as people accept paper. The moment someone demands physical delivery, the entire structure faces stress, because physical metal cannot be rehypothecated infinitely. It cannot be transferred instantly. It cannot be printed into existence. It either exists in a specific vault, or it does not. And when 5,000 contracts demand delivery simultaneously, the system must prove something it has never had to prove at this scale, that the metal behind the paper is real. Right now, in trading desks across New York, London, and Zurich, people are pulling up inventory reports. They are checking warehouse locations. They are calculating transit times. They are reviewing custody chains. They are asking themselves a question that sounds simple, but has enormous implications. Where is the silver? Not where it is supposed to be according to the database, where it actually is. Because on Monday morning, someone is going to show up with legal paperwork, and they are not going to accept excuses. They are not going to accept delays. They are not going to accept cash. They want the metal, and the clock is running. There is a spreadsheet somewhere in New York. It contains numbers that billions of dollars depend on. Rows and columns, warehouse codes, bar numbers, weight measurements, custody dates. The spreadsheet says 41 million ounces of registered silver sit ready for delivery. But spreadsheets do not lift heavy metal bars. Spreadsheets do not account for the truck driver who called in sick, the warehouse that is closed for renovations, the inspection that takes 3 days instead of 3 hours, the paperwork error that freezes a shipment at customs. Spreadsheets live in a perfect world where everything works exactly as designed. Reality is messier. Let's examine what 41 million ounces actually means. Silver bars come in specific sizes. Most COMEX approved bars weigh between 750 and 100 troy ounces. Call it 1,000 ounces average for simple math. 41 million ounces equals roughly 41,000 individual bars. These bars are not sitting in one location. They are spread across approved warehouses. Delaware, New York, Chicago, some international facilities. Each warehouse maintains its own inventory system, its own security protocols, its own operating hours. Moving 25 million ounces means coordinating the transfer of approximately 25,000 bars in 72 hours over a weekend. Now add the complications. Each bar must be verified, serial numbers checked against registry records, weights confirmed, purity assayed if there is any question about provenance, chain of custody documented at every step. This is not moving boxes of paper. This is not transferring digital files. This is physical metal that weighs over 31 kilograms per bar. 25,000 bars at 31 kilograms each equals roughly 775 metric tons. Try to picture that weight. 17 fully loaded semi-trucks, 25 standard shipping containers, the equivalent of 12 adult elephants, and someone wants it delivered by Monday morning. But weight and logistics are only part of the problem. The real crisis sits in a different column of that spreadsheet, the column labeled available. Because registered inventory is not the same as available inventory. Here's what the public sees. 41 million ounces registered. Here's what the vault managers know. Of those 41 million ounces, approximately 8 million are already allocated to contracts expiring in March. Those bars cannot be touched. They are committed, spoken for. Another 5 million ounces sit in a warehouse in Delaware that is currently undergoing security system upgrades. The facility is operating at reduced capacity. Metal can be removed, but not at normal speed. Definitely not at emergency speed. Another 3 million ounces are involved in an ongoing legal dispute between two entities claiming ownership of the same inventory. The metal exists. The paperwork is tangled. It cannot be moved until lawyers finish arguing. Another 2 million ounces are in bars that were recently deposited and have not completed the full verification process. They count toward registered inventory, but they cannot be delivered until final assay reports are filed. Suddenly, 41 million ounces becomes 23 million ounces of truly available metal. And someone just demanded 25 million. The math does not work. But even that number, 23 millions, might be optimistic. Because there is another problem. A problem that nobody at the COMEX wants to discuss publicly. Some of that registered inventory has been counted multiple times. The same bar, sitting in a warehouse in New York, appears on 3 different custody reports. One report shows it as registered COMEX inventory. Another report shows it as collateral for a loan between 2 bullion banks. A third report lists it as backing for a silver ETF. All 3 claims are technically legal. The contracts were structured carefully. The lawyers made sure everything had proper documentation, but when delivery time comes, well, that bar can only go to one party, not 3. 1? So which claim has priority? The futures contract holder demanding delivery, the bank that accepted it as collateral, the ETF investors who believe their shares are backed by physical metal? This is the rehypothecation problem, and it does not show up on spreadsheets. Now add one more factor, industrial demand. While the financial world plays games with paper contracts, real companies need real silver. Solar panel manufacturers, electric vehicle producers, medical device companies, electronics firms, their demand has been growing, not because of speculation, because of actual consumption. Over the past 6 months, registered COMEX inventory has been declining. Not dramatically, not in a way that triggers headlines, but steadily. 6 months ago, registered inventory stood at 58 million ounces. 3 months ago, 47 million ounces. Today, 41 million ounces. A clear trend, metal flowing out of warehouses, into factories, into products, into the real economy. And now someone wants to remove another 25 million ounces. If this delivery goes through, if the COMEX actually produces 25 million ounces by Monday, the registered inventory drops to 16 million ounces, maybe less. If the real available number is lower than reported, that is enough to cover normal monthly delivery requests? Barely. But what happens if a second entity files a similar notice next week? What happens if 3 more file the week after that? What happens when the spreadsheet runs out of numbers? The vault managers know the answer. They are staring at their screens right now, running calculations, making phone calls, checking warehouse manifests, hoping that this is a one-time event, hoping that nobody else gets the same idea. Because if they do, the entire system does not just face stress, it faces collapse. And the metal that everyone assumed would always be there turns out to be a number on a screen, nothing more. March 2008. Bear Stearns collapsed. Not because the company ran out of money, not because their assets were worthless, but because someone asked to see the collateral, and the collateral was not where it was supposed to be. The housing market had been built on a simple assumption that mortgages were safe, that the securities backed by those mortgages were solid, that the ratings agencies were correct. When that assumption broke, when people started asking, "Show me the actual mortgage," when they demanded to see the underlying asset, the entire structure collapsed in days. What is happening in the silver market right now carries the same DNA, a system built on leverage, on rehypothecation, on the assumption that most people will accept paper instead of demanding physical assets. And now, someone is demanding to see the vault. The implications reach far beyond 25 million ounces of silver, because silver is not unique. Gold operates on the same model. The London bullion market, the COMEX gold contracts, the allocated versus unallocated accounts, all of it runs on fractional reserves. Platinum, palladium, copper, nickel. Every major commodity market uses similar mechanisms, paper claims vastly exceeding physical supply, leverage ratios that only work if nobody asks for delivery, and they are all connected. When a major bank holds silver inventory, they are not just holding silver. That metal serves as collateral for other positions. Those positions connect to currency swaps. Those swaps link to interest rate derivatives. Those derivatives tie to pension funds, insurance companies, sovereign wealth portfolios. Pull one thread, and the entire fabric shifts. If the COMEX cannot deliver 25 million ounces of silver, what does that say about their ability to deliver gold? If registered inventory numbers are unreliable for one metal, why would traders trust the numbers for another? Confidence is contagious. So is doubt. Right now, somewhere in London, a trader is looking at their gold position. They bought 100 contracts 6 months ago. They plan to roll them over, take profits, move on. But now they're thinking differently. If someone can demand 5,000 silver contracts and create chaos, what happens if someone does the same in gold? What if, instead of settling for cash, they file for physical delivery too? That thought, multiplied across thousands of traders, creates a shift in behavior, a shift in assumptions, a shift in what people are willing to accept. And shifts like that do not stay contained to commodity markets. Because the real question is not about metal, the real question is about money. Why would an entity demand $1.9 billion worth of physical silver instead of just taking the cash settlement? Cash is easier, more liquid, immediately usable. Unless you do not trust the cash. Unless you believe that dollars in a database are less reliable than metal in a vault. Unless you see something coming that makes physical assets more valuable than financial promises. This is where the currency question emerges. For the past 2 years, central banks around the world have been buying gold at record levels. Not selling, buying. China, Russia, India, Turkey, Poland, Singapore. They are converting currency reserves into metal. Quietly, consistently. They are not doing this for investment returns. Central banks do not chase yields. They are doing this because they see the same thing this anonymous silver buyer sees. A monetary system under stress, a debt structure that cannot be sustained, a future where physical assets matter more than digital promises. And if central banks are thinking this way, why would private entities be any different? Sovereign wealth funds, family offices, strategic investors who operate on decade-long time frames. They have capital, they have patience, they have access to information that retail traders never see, and some of them are making a calculation. That the risk of holding paper now exceeds the inconvenience of holding metal. This delivery demand might be from a Chinese manufacturer who needs silver for solar panels, or it might be from a Middle Eastern sovereign fund diversifying away from dollar exposure, or it might be from a private entity that knows something about monetary policy that has not been announced yet. The identity matters less than the pattern, because if one entity is thinking this way, others are too. And the system, the entire precious metals pricing mechanism, the leverage, the fractional reserves, the rehypothecation, all of it depends on those entities not acting on that thinking. The COMEX has until Monday morning, 72 hours to prove that the vault is real, that the inventory numbers are accurate, that the system works. If they succeed, if 25 million ounces gets delivered smoothly, then maybe this was just an anomaly, a one-time event, a story that fades into footnotes. But if they struggle, if there are delays, disputes, partial deliveries, cash settlement negotiations, then every trader in every commodity market will learn something important, that the emperor has no clothes, that the vault is empty, that the numbers on the screen are just numbers. And when that lesson spreads, when confidence breaks, When everyone rushes for the exit at once, the question will not be, can they deliver 25 million ounces of silver? The question will be, what else have they been lying about?